Howdy. Welcome back to Dion Talk. Why do things cost so much more? I'm not going to talk about supply chain issues or record wage inflation. I want to cover a really fundamental concept of why prices keep going up and how, even if inflation goes down, prices will continue to go up. And what you can do to avoid being hurt by this or be hurt less. The purpose of my content is to help the average individual realize that you can reach financial freedom and make work completely optional in 10 years or less, even if you're not starting from the best position. That's what I did. I was a single parent with 3 kids, making $17 an hour after being laid off from a police department during the 2008 recession, who found out about $89,000 in bad debt in my name I didn't know about until the divorce. I was able to make work optional in 8 years. I worked for 4 more years because I loved my job, but eventually time freedom won out and I retired early. If that sounds like something that you would like to do, hit subscribe and check out some of my videos on how I did it. In this video, I'm going to go over something really basic, a concept some people seem to want to make really, really complicated. When I make my videos, I have to use language and ideas that I would understand. I have been a Marine, a cop, and a truck driver. I really like simple. And blue crayons are my favorite. They taste the best. I want to go over the growing cost of things and then apply this to real estate. As an investor, we eventually learned that inflation is our friend. But when we first start investing, it doesn't feel like it. Here's my analogy. Let's say 10 people are on an island. And on this island, we have 100 tennis balls. We all decide to use the tennis balls as currency. So each of us gets 10 tennis balls. Very socialist way of starting this out, but it doesn't end that way. Using the tennis balls as currency, we could have this person, my sister, who I haven't seen for 27 years and randomly ran into the other day. We should stay in touch more.
But not today.
Since she's not the lazy one in our family, let's say she catches a fish. I buy the fish from her for a tennis ball. Then I cook the fish. I raised 3 kids by myself. Each one was very picky, and while I have taken an oath to never cook again in my life, in this story, I actually cook the fish. And then I sell the fish to somebody else for 2 tennis balls. We associate the tennis balls with time and effort. My sister catches the fish. For her, that was worth a tennis ball. I prepare the fish, and for me, that was worth a tennis ball. This person wants to consume the fish, and for them, it was worth 2 tennis balls because they didn't have to catch it and they didn't have to cook it. An extremely basic example of how capitalism works. We all started with 1/10 of the value of the wealth on the island. There were 100 tennis balls. We each had 10. But now, let's adjust for inflation. If a crate washes up on the shore with 100 tennis balls in it, there are now 200 tennis balls on the island. And let's say the guy in the first story who would have bought the fish from me finds the crate. Now, 9 of us have 5% of the value of the wealth on the island because we have 10 out of 200 tennis balls. And the person who found the crate has 55% of the wealth on the island because they have 110 out of 200 tennis balls. And again, let's say my sister, the not lazy one, catches a fish. But since there's more wealth, she'll sell it to me, but she wants 2 tennis balls. So I buy the fish for 2 tennis balls. I, again, prepare the fish, and I sell it to the rich guy for 4 tennis balls. The same amount of time and energy and effort went into catching the fish and preparing the fish, but since there's more wealth, it would take more to convince her to sell it to me and more for me to want to sell it to the rich person. And since they have 110 tennis balls, paying 4 for the fish seems okay. My sister made twice as much. I made twice as much. But if you really think about it, we're not richer or poorer. There's just more wealth on the island to be divided up. The value of the fish never changed. How much currency there was what made it worth more currency. In 2019, let's say we had 100% of the wealth in the United States. And in 2020, the Fed created a bunch of money basically out of thin air. And for me, the best thing about the Federal Reserve Bank is that they have an amazing marketing system because they are not federal. They don't work for the government. They don't belong to the government. They are not a reserve. They don't keep stores of money, and they're not a bank. You and me can't go in there and transact business with the Fed. But the Federal Reserve Bank created a lot of money in 2020. And it's not just the printed money. We were creating around $120 billion a month throughout that entire year. Some of it was in currency, and some of it was assets that the Fed purchased to keep on their own balance sheet. This increased the amount of wealth in the United States, making the amount that you and I own worth less. Not worthless, just worth less. Just like with the tennis balls. If there are more tennis balls on the island, it takes more tennis balls to get the same things. Zuber said it really well in one of his daily updates, and I recommend you check it out, the YouTube channel, One Rental at a Time. Inflation was over 8%, and recently it dipped all the way down to 7.7%. This doesn't mean things cost less now. This means they cost more, slower. Here's how I want to tie this to real estate. Let's take out housing supply, forced sellers, new builds, interest rates, and all the things that actually do impact housing prices. And let's just look at inflation. If you wanted to buy a house in 2019 and it would cost you 100 tennis balls, but you waited because people told you that there was a crash coming, so you waited, and in 2020 inflation was 8%. If you were going to buy the house in 2020, it would cost you 108 tennis balls. But prices had gone up, and people were uncertain, so they said to wait to buy because a crash is coming. And in 2021, inflation was again 8%. It would now cost you 116.64 tennis balls to buy the house. So there are a lot of people saying, there is no way I am paying 116.64 tennis balls for a house I could have got 2 years ago for 100 tennis balls. That would be just stupid. I'm going to wait for inflation to come down because the Fed has a targeted interest rate of 2%. Their goal is to get it between 2 and 3%, right? But we're so high, let's just say right now we want to get the Fed rate down to 2% so you can buy that house. I actually think we're pretty far from ever getting the inflation rate down to 2% again, but let's just say magically, poof, you have 2% inflation. This means that if you buy the house in 2023, when you waited for inflation to magically come down to that 2% number, the house that you could buy for 100 tennis balls in 2019 will now only cost you, it won't cost you 116.64 tennis balls. It's now going to cost you 118.97 tennis balls. Lower inflation does not mean the price of things comes down. It means it goes up slower. And again, we took out a lot of things that could increase or decrease housing supply. A lot of people say we have an increased inventory because there's more properties for sale on the MLS. Well, new listings are down in most markets. What's happening is properties aren't selling. That doesn't mean they're forced sellers. What would cause prices to come down is an increase in supply of forced sellers, not just properties for sale. Technically, every property is for sale if you have the right amount of money. And this doesn't take into account you waiting. You could have bought it in 2019. You waited to 2021, 22. Now you're buying it in 2023 for more tennis balls, but you possibly were paying rent that amount of time, or you weren't getting the cash flow of owning the asset, and you weren't gaining the appreciation of the last couple of years. Take out the opportunity cost of having owned that asset. And let's look at the cost of waiting. This is why things cost more. There are more and more tennis balls in circulation every day, meaning it is going to take more and more tennis balls to buy the things that you want, even if inflation comes down. So someday I'm going to make a video where I just point out a bunch of negative stuff and make the world sound terrible and not give you a solution.
But not today.
There are two strategies that have worked well for me to literally become a millionaire and make work optional because of inflation. First, I acquired cash flowing assets like real estate that go up in value with inflation. The value of a home really hasn't changed since 1970 by much. The number of tennis balls it takes to buy it has gone up because there are more tennis balls in circulation, but the value of the house is almost the same. So inflation impacts appreciation so that you have an asset where inflation is actually going to benefit you. And second, I like to use good debt. I know some people don't believe that good debt exists, but if it wasn't for debt, I'd have to work. And I'm not saying go out and over leverage yourself or use adjustable rate mortgages or do anything where you have something like a loan reevaluation period, but I like 30 or 40-year fixed rate debt where in the future, because there are more and more tennis balls in circulation, it is going to be easier for me to pay that debt off. An example is rents go up. Mortgages basically stay the same. Since we've started tracking the data in 1940, rents have never once market-wide gone down. You could be in an area where rents tank. If you're near Detroit, when all the car manufacturers move away, or if you're in the Silicon Valley, when the dot-com crash hits that market more than almost anywhere else, you could see rents dip. But if you invest, basically watching a lot of my content to figure out the ways that I diversify my portfolio, investing in areas where there are several economic drivers, a base, a port, a college, hospital, Boeing, Amazon terminal, an attraction like a beach or a lake, large population. And then I diversify my tenant base. I like to go 1/3 military, 1/3 Section 8, 1/3 working or retired, so that a lot of things would have to happen to the economy before my rents would ever see an impact. And if we ever get to that point where my rents are impacted, there's a lot more problems than me worrying about rents coming in. And don't over leverage. When I was growing my portfolio, I liked to stay around 70% loan to value. So if I had $100,000 worth of property, I wanted 70,000 of that to be leveraged. 30,000 was equity. So if I ever had to walk away from the asset, I could do it without having to write a check. This also helped me maintain a gap between rents coming in and mortgages going out, so I could handle a rent decrease without having to go into my own money to cover my expenses. When I got closer to retiring, I increased my reserves. When I had the W-2, I kept around $30,000 in reserve. Now that I'm retired, I keep around 50, so I feel a little more confident in my SWAN account, that sleep well at night account. And I increased my loan to value goal to 50%. I want to be around 50% loan to value. And I think I'm around 40. So I'm probably going to be a little less leveraged on the next property that I purchased. It is not my goal to pay off my mortgages. If you'd like me to explain that, let me know in the comments below. Do me a favor. I know I ask for this every now and then, but I'm actually curious. In the comments below, how is inflation impacting you? If places like McDonald's are starting at $17 an hour, where a few years ago, $12 an hour seemed to be the norm in the areas that I'm at, inflation is impacting wages. In my market, inflation is greatly impacting rents, which sucks for renters. That's why I'm trying to help people who are renting become owners who then have renters. But I'm curious, the people who watch this channel, how are you impacted by inflation? Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.